Well, welcome everyone. If you're here for the personalized income strategy class, you're in the right place. Thank you all for joining us. It's been a long day, right? 7 o'clock. I want you to make sure that you're in a quiet place. Close the doors, get yourself a nice drink, and just unwind. And I want you to open your minds and listen. I want you to also give yourself a little praise. I mean, I would say the best asset is yourself, and you're all taking the time to invest in yourself tonight. So thank you for that. Make sure you grab a notebook. We're going to go through some things that you want to take notes on. My name is Rebecca Samples, and I've got our managing partner here, Sean Munyo. He's going to be joining us as well to go through this income strategy that I believe is one of the smartest tactics investors can use in the environment that we have today. So a little bit about who's Bequest. We are a boutique asset management firm located in Sarasota. We've been in business for about 5 years now. And Bequest's purpose is to help everyday investors earn steady, high returns so they can confidently build financial freedom. How does that sound for everyone? And the most importantly, they have a 4C approach, which I found is awesome. The first C is cash flow. They're focusing on assets that cash flow right away. And then the second one is control. They want to make sure that they have control of all their assets. And one of my favorites is community. Their growth strategy focuses on community investing in a socially responsible real estate and energy assets, which contribute to a better world. And the last C is comprehensive. You want to make sure that assets is like you can understand. You know, Warren Buffett says investments must be rational. If you can't understand it, don't do it. So we're going to take our time today and we're going to try to break through everything down so it's easy for you to understand. Again, we're going to talk about an idea on how to create your personalized income strategy. And I'm going to talk to you a little bit about how you can align it with your purpose. Again, my name is Rebecca Samples. I'm going to be your host for this evening. I'm a cash flow strategist, and I focus on safe, steady, and passive, help clients with their portfolios that are safe and passive. And then I've got my managing partner here, Sean Munyo.
Yes, thank you, Rebecca. I'm looking forward to this evening.
All right, well, let's get started.
Rebecca, real quick, somebody mentioned that the chat wasn't enabled. So I don't know. I did put a message in the chat. I don't know if anybody can see the chat, but if you can, just drop something in there. I know we would like to communicate with you along throughout the evening.
Okay, thank you for that. We do have the question and answers. I can see that chat as well. Sorry about that, guys.
Okay, looks like the chat might be disabled, so we'll have to use the question and answer piece tonight.
Okay, that sounds great. Well, I apologize. I'd love to see where everybody is from. Like I mentioned before, we're here in Sarasota, beautiful Sarasota. If you can see over let's see, right here. We got a building right down here. We're right downtown Sarasota. So we have events throughout the year. I want you to all just keep an eye out on your emails as we go throughout after this webinar, and keep a lookout on our social media, LinkedIn, on what's happening. We've been traveling a lot to different states, hosting investor dinners, and we'd love to have you, love to meet you in person.
Rebecca,
here we go. We got the chat going.
Yes.
Awesome. Great. We've got someone from Hawaii. Wonderful. One of my favorite places on earth. Awesome. Arizona. Fantastic. Love it there. Where else? Awesome. Chicago, San Francisco, Dallas. Awesome. Great. Oh, it's exciting. Oh, I love it. See it coming in. Wonderful. All right, now we got it going. Now I feel like we can rock and roll. All right, I'm going to share my screen here. All right. Can everyone see my screen? Thank you all for your patience. Let me pull up that chat here in a minute. I've got the other one up. 1 second here. Pull up my other screen. Awesome. Okay. So we're going to talk a little bit tonight about your personalized income strategy. And I want to just start it off here. You know, the market's going up and down. There's a lot of volatility. People are kind of uncertain on what they're doing. And like I mentioned before, is we're going to go through a strategy that is going to focus on steady passive income. Oh, there we go. All right, I've introduced myself, Rebecca, and we've got Sean Munoz here. He is one of the managing partners here at Bequest, and very exciting treat that he's here with us tonight because he leads the strategy for Bequest, and through his cutting edge technology and innovative strategies while he's maintaining people first. And that's the most important here at Bequest. Under Sean's leadership, Bequest has become the fastest growing asset management firm here in Sarasota, setting a new industry standard in efficiency and client focused solutions. So that's super exciting. I want to start off with a quote by Benjamin Franklin. So again, everybody take some time, get some pen and paper out. And what Benjamin Franklin said is here is wealth isn't about the man who has it, but the one who lives it. And I think sometimes over time that we start to learn that wealth doesn't always bring you happiness. It's about how we live our lives. And I believe bringing true happiness is by adding value to this world. So a question to think about is, why are you here tonight? What is your purpose? What are you trying to achieve? I want you to write down here, if you all have your pen and paper out, is if I only had a portfolio that generated X, I would have X. What does that mean? If I only had a portfolio that generated what? What are you looking for? What is that consistent passive income that you're looking for? And what are you trying to achieve? Trying to spend some more time with your kids? Are you trying to travel more? What is your goal? Without understanding what your why is and what your goal is, you're not going to take action. You're going to be stuck. And during these times of whether the market is up or down, you're still going to have a hard time making proper decisions. So let me fill in that blank for you. If I only had a portfolio that generated steady return and income without stock market stress, I would have a peace of mind and freedom to enjoy life. If that's something that you're looking for today, put that in the chat. What are you looking for? We've got cash flow, retirement income. Yes. Awesome. What does that look like for you? So the problem is typical financial advisors tell you to set it and forget it. And what does that even mean? What does that look like? So public markets are volatile and overvalued. Excuse me. Bonds are barely outpacing inflations, and investors are striving for returns. Sean, what do you think about that? What are some of your comments on this whole set it and forget it?
Yeah, thank you, Rebecca. And it's really interesting times right now. I was kind of writing down some ideas this afternoon as we were preparing for this, just thinking about what's going on in the marketplace right now. We're in highly uncertain times, and likely uncertainty is a word that has been used overused this year. But I was just writing down some very basic observations that I thought was interesting. Like the stocks are rising since April 2nd. Stocks are rising like the trade war is over, except for today, right? It's down, but stocks have been rising since April 2nd, like the trade war is over. Yet gold is rising like the trade war is escalating. So which is right? Now, if you look at the yields have been rising like the US has avoided a recession, right? Yet if you look at the oil prices are falling like the US is entering a recession. And if you
Mm.
look at the dollar index, it's falling like inflation is gone. Yet Bitcoin is rising like inflation is on the rise. These are very uncertain times. And the title of this slide that we have here is Volatility Will Continue in 2025. Just a few weeks ago, or actually just a week ago, when it was announced that China and the U.S. had come to terms and likely not going to enter a trade war, everybody thought the volatility was over. But yet again, today we have even more volatility in the marketplace, and so a lot is going on. We know the U.S. just lost its AAA bond rating. That was a big deal, and that's what we're seeing in the marketplace right now: a tremendous amount of uncertainty, and that's really what the problem is, Rebecca. I think it's very clear.
Yeah, I mean, I see that here with the charts that you have, and it starts to get me to think, it's like, what mindset am I having? I come from third generation of real estate investing, and my mindset was always in cash flow. But I've got a lot of friends that are in the traditional mindset. So it's like you look at this and it starts to get you a little concerned. Um, Leading into that, what does that look like? What does the traditional mindsets look like for, and some of this might be familiar. So we're all taught with the buy and hold, right? Versus monthly income. Hope for the market gains. But, cash flow mindset, where I like to hang out at is the predictable returns. What you mentioned about with the volatility earlier in those slides is, that life is stressful enough now having to worry about what returns I'm going to get with my money, which kind of jumps down to like the retirement nest egg. And we've got some people in the chat that are looking for a retirement. Again, financial advisors, set it and forget it. Trying to set up a number that you're trying to achieve that is it even going to be that exact number by time you get to retirement? What about if we shift our mindset to retirement paycheck? Looking at your cash flow, what are some of your monthly income expenses? How can you set up passive income for that? And then not being dependent on Wall Street, you know, focusing on private assets. I want to ask you, if you feel comfortable, put it in the chat. What side of the table are you on today? What side were you taught? Where do you want to be? We've got some cash flow mindset. Awesome. Cash flow. Great. Exciting. Yeah. Cash. When I was younger, I used to say cash is king. Well, being in this space, it's cash flow is king. So moving into the next is alternatives. Again, is going back to what we were programmed is, okay, when you're in this market and you're looking for some cash flow, well, what kind of assets cash flow? So we start to think and might not be the certain assets to invest in. So, okay, well, how about some stocks and ETFs? Are they cash flowing? Well, some of the risks of it will be, well, market volatility, no set return. What about REITs? Yeah, they might cash flow, but it's trade on the public market. What about bonds? So low yield and inflations. And then, we threw in there annuities is, you lock it up. You got to lock it up for 10 years and it becomes illiquid and you're only allowed a certain amount. So gets the low returns, you've got some fees. And what about crypto? It's high risk, no return. So most investors are still chasing the volatility market. Sean, do you have anything to add to this?
Yeah, Rebecca, if you go back one slide, it's just an interesting point that I like to make. the traditional mindset versus the cash flow mindset. And so, as investors, likely everybody on this call manages a portfolio. And a lot of people are always talking about, hey, did you hear about this stock and this company and this AI company, and you can invest in it. What we don't realize what we're doing, but in the most of the times that we invest in a company, we want that company to generate a tremendous amount of cash, right? You look at those blue chips and you actually look at Apple, which a lot of people have invested in. Do you know that the reason the stock is where it is today is because Apple generates $100 billion in cash every 90 days, right? And that's why you love that stock. You invest in that stock because they are generating so much cash. Yet you look at your own portfolio that you manage and you're trying to find cash flowing assets, but nothing is actually cash flowing. You're hoping that that Apple stock will appreciate one day and then, well, I'll sell it to generate cash and I'll live off of it. Yet the companies we are investing in, they're generating cash, and that's why the value of the assets are going up. And so this is the difference between the traditional mindset and the cash flow mindset. We should be using the cash flow mindset when we're building our own portfolios. And so if we go back to the alternatives, what are the alternatives for the market? You laid out here that there's not many options when you go to the traditional markets.
Mm-hmm.
Go to the traditional markets and you don't have many options as it relates to generating cash flow. You might find some dividend stocks or some ETFs, but you're constantly having to trade in and out of those, and you might not get the yield you're expecting because the stock price might have gone down. And so this game that you play that's not passive, but by no stretch, it is not passive. It's actually work to trade some of these assets. And so there's not a whole lot of options as it relates to investors out there. And what I like to mention, Rebecca, is I have a good friend of mine. His name is Ray Dalio. I don't know if you've heard of Ray, but I got to meet Ray a few years ago, and he talked a lot about the alternative markets. And what he told me was, he said, Sean, do you know what the holy grail of investing is? And of course, when a guy like Ray Dalio tells you the holy grail of investing, I was at a conference in 2022. It was a very large conference, and obviously he wasn't speaking to me, he was speaking to the crowd. But he said, the holy grail of investing is to find 8 to 10 streams of non-correlated assets. And I'm like, non-correlated? He's like, yes, non-correlated assets. And if you can find those types of assets, you will in fact have reduced 80% of the risk in your portfolio. And so, finding those types of assets are very, very difficult.
Yeah,
I don't know if
I
you were going
would
to say
agree.
something, Rebecca. Sorry.
I would agree. No, I'm agreeing with you. It is hard. You don't hear about, some of these assets that you're talking about. And I kept going back to one of your C's is control. I mean, I look at this and do I have any control over this?
Yeah. Yeah. Well, I don't know if you know this, but it wasn't but just a few weeks ago, another hero of mine, Larry Fink. I don't know if you know who Larry Fink is, but Larry Fink is the chairman and the CEO of the largest asset management company in the world, BlackRock. And he said something earth-shattering, and something that has been a tradition for over 70 years. And I kind of looked this up, but for the last 70 years, investment advisors have been telling investors who are managing portfolios that your portfolio should consist of what everybody knew was the 60-40 concept, and that is
Yep.
60% equities, 40% bonds. And in fact, it goes back to the 50s and the 60s. So a long, long time. And he said, you know what? In today's world, that no longer works. That 60-40 method no longer works. And in fact, in today's world, you need to reshape your portfolio so that it's a 50, 30, 20. And now, what is this 20? What is this new 20? And he called it private assets. But it's the alternative markets. The alternative markets. Why? Because you're looking for non-correlated assets. You're looking for things that don't move up and down depending on what's going on in the market, depending on what there's you're looking for ways to generate cash flow in your portfolio that are non-correlated to the S&P 500. That is found in the alternative markets, and it's not easy to find investment opportunities that are in the alternative space. There's no marketplace for you to go to that says, "Oh, I'm looking for alts. I'm looking for alts." It's actually very difficult to find, but the largest asset manager on the globe is telling you that you need to find these types of assets. You need to put them into your portfolio.
That's exciting. Thank you. I mean, I'm just hearing about it and I'm getting excited about it. And what are these alt spaces and what are some of these assets look like? And I know Bequest falls in line with one of those. So
Yeah.
what's this opportunity that you're talking about? Share a little bit about how Bequest sets up this strategy and how they can help our investors.
Yeah. Well, thank you. Thank you, Rebecca. So, Bequest is in the alternative space. It's a private fund. It's focused on fixed income. We invest in different things here. It doesn't require active management. There's no stock market risk here, no leverage, no complex strategies that we're doing here, no illiquid positions. We are focused on accessing a market that used to be available only to the ultra wealthy. It's a $30 trillion market. I mentioned it was true diversification from the S&P 500, a true disconnection from market correlation. What is it? It's the power of real estate and energy in your portfolio, and that's what we offer here at Bequest. And you can go ahead with the next slide, Rebecca, and one more. We'll talk a little bit about what real estate investing is at Bequest here. It's a little unique, different, likely something you've not heard before, and it's called mortgage note investing. And I like to explain what it is when I talk about a story. And for me personally, I am a third generation real estate investor. And when I got my first corporate job, I would take my hard-earned paycheck and I would do what my grandfather did, and that would go buy real estate. And so I owned, everybody would say, slumlord properties, and I was a proud slumlord. And I would buy these properties. I'd fly around the country. I was selling technology to Fortune 100 companies. I'd come home on the weekend and kind of clean up after people. But what I realized is that when I had my properties, some of my properties I would finance. And what I noticed was that sometimes I didn't get paid my rent, right? There was always an excuse as to why I didn't get paid. But you know who got paid every month? The bank got paid every month. The bank got paid every month. And do you know what else? When the toilet broke or the air conditioning broke, which happened a lot in the summer, or the pipes broke or the roof leaked, do you know the bank never got a phone call? I got the phone call.
Yeah.
So as
Yeah.
I'm building this portfolio, I'm thinking to myself, wow, the bank's got it great. Like they have an amazing, because if I don't pay my mortgage on this property, they basically get to take my property at a discount, by the way.
Wow.
And they don't have to do anything but collect a paycheck. And so I thought to myself, how do I upgrade my position? And it was in about 2017 that I found a book on Amazon called Note Investing Made Easier that taught me how to buy mortgages off the secondary market. And that's really what we do here at Bequest. And in fact, the author of that book is now my business partner, Martin Science, helped me start Bequest here in 2020. We launched the fund together after he wrote the book, after he taught me the business in 2017. We came together and launched Bequest because the power of cash flow investing in the mortgage note investing is unlike anything I'd ever experienced, and is very powerful.
Awesome.
We buy very specific types of mortgages. And so I'll just go into this briefly, and we can talk more about this, and I can answer more questions about this later. But we buy what's called reperforming mortgages. You might have ever heard of that, but a reperforming mortgage is when a borrower goes out and gets a loan and for some reason falls on hard times. It's usually three things. It's always the same three things. It's either
Hmm.
a divorce, it's either a loss of employment, or it's health related. Three temporary situations. And most of the time, the borrower gets remarried, comes out of it, the borrower gets healthy again, the borrower finds a new job. We can all experience, I'm sure we've all experienced hard times at some point, but because that borrower fell on hard times, and because they might have got back on their feet and the bank had to modify those loans, they modify the terms of the loan, there is now a mark on that loan. And so the banks um, keep those on their balance sheet, but when the auditors and the compliance officers come around, they say, hey, you've got a bunch of um, modified mortgages on your balance sheet. You're going to have to over collateralize those. You're going to hold extra cash on your balance sheet for those. And so banks don't like to do that.
Hmm.
So they sell those assets off. These are the borrowers back on their feet paying again. But because there was a change in the terms of the loan at some point over the last 5 years, the bank is required to sell them. And so here at Bequest, we are a buyer of those types of mortgages. These are great mortgages, single family homes all across the US, in suburban America. We buy these loans and we hold those loans for cash flow. And
Wow, that's amazing. That's
yeah,
amazing, Sean. I just want to add to that. So that's basically another one of your four C's is that it's community. We talked about it in the beginning, investing in assets that help the community out. So you're basically when these families get stuck on hard times, you're helping them stay in their homes.
we are helping. Now we're actually buying them already performing, right?
Hmm.
So somebody helped them out. We are taking it on as for cash flow inside the fund, and so borrowers are making payments to us. We're distributing those payments to our investors. But if that borrower falls on hard times again, we actually have a loan modification shop inside Bequest. We have a team of individuals who are trained to work with those homeowners to potentially modify the terms of those loans again, keep them in the house, and do what you said, Rebecca, is
Yeah.
that's make sure that we're doing right by those neighborhoods. If you've ever lived in a house that has gone through foreclosure, it will impact neighborhoods, it will
Yeah.
impact communities. Imagine living next door to a house that's in foreclosure. We want to work with those homeowners, and keep them in the house, keep them paying the mortgage. And so that's what we do here at Bequest. And in fact, that's what mortgage note investing is to us.
I think we've got some examples showing what a mortgage note looks like.
Yeah, absolutely. So we do buy the paper. It's originated by the bank, Wells Fargo, Bank of America, PNC. And so we buy the mortgage, we buy the note, we buy them in tranches, and we become the bank. The fund owns the paper, and so if you go to the next slide, there's just examples of some properties. But we are the bank in essence. Borrowers make payments every month. We collect those payments. They go to our licensed servicers who then distribute the cash flow to us, and we distribute that cash flow to our investors. So that's mortgage note investing here at Bequest. It's the cornerstone, one of the pillars of what we do here. And we talk about non-correlation because what's going on in the marketplace has zero impact as to whether the person in this house is going to pay their mortgage, right? They're not. They still went to work today. They didn't really care that the S&P was down eight, or the Dow Jones was down 800. They're still going to make their mortgage payment. And so that's the power of non-correlated assets that you have in your portfolio. Whatever is going on, this borrower is going to pay their mortgage at a zero impact as to what's going on in the market. We're going to collect that payment. And we're going to send out distributions to our investors. And so that's the power of mortgage and investing here at Bequest.
Awesome. Awesome. Thank you, Sean, for that. Share a little bit about the other asset. You mentioned energy. What does that look like? Is that like oil or windmills? Like what kind of energy investing are we doing here at Bequest?
Yeah, thank you, Rebecca. This is modern energy investments. And so some of you may not know, but before I started Bequest with my business partner, Martin Sines, I was building data centers for some of the largest Fortune 100 companies. I built data centers for Amazon, Google, Facebook, Microsoft. We were building data centers back in the day. And a story that I like to tell is when we were building these facilities, people were not focused on the cost of energy. And in fact, we were more focused on, was that facility in a earthquake zone? Was it in a path of a runway for was it next to a uh, railroad? Like what were the potential hazards that were associated with putting sensitive data near something? And we would build these data centers, and never did we ever think about the cost of energy. But today, that is becoming a major input as to where they're building these data centers. It's said that over the next 10 years, the amount of energy needed to take us into this next AI environment here in the US is tremendous. Like a 10x increase in energy consumptions. And so because of that, we have made investments in what we call energy parks. And in fact, we have an energy park in South Texas where we have locked up power at a substation. Here's an example of the energy park. We've locked up power at a substation that's right next to this facility. And so we have about 7.5 megawatts worth of capacity that we have under contract. We take that power, we condition that power, we build the infrastructure. You can see here, there's pods that are here, there's transformers, all of these things that are here. We build out the infrastructure and we lease slots inside these containers to companies that use it for both blockchain and AI workloads.
Wow.
And so what we do here is we sell power. We buy it for about 4.5 cents per kilowatt hour, and we're selling it for about 8 cents. And so we make a power arbitrage here. Why? Because we have locked up a lot of power. We have made investment in the infrastructure. We make it easy for tenants just to come in and drop their computers, and we send them an electric bill every month, and they're happy to pay that. And the most important thing, it generates cash flow. Every month, we take that cash flow and we distribute that cash flow to our investors. That's what modern energy investing is here at Bequest, and that's what we do. So let me take you through a little bit about Bequest. If you don't know who Bequest is, we've been around now. We crossed over our 5th year of generating consistent, predictable returns for our investors. And in fact, 63 consecutive months of distributions. We, if you look at our returns, we have beat any investment product out there as it relates to, dividend ETFs or any other fixed income investment strategy that you find in the marketplace. We we have beat it with our consistent, predictable returns. We are focused on building a growth into our portfolio. We are resilient. We have different policies that are in place that allow our investors to be protected if, in fact, there's changes in the marketplace. And let me give you a brief example of our resilience. I mentioned to you that we own mortgages. Now, if the borrower stops paying, we talked about how we help them try to keep them in the home. But in a very bad situation, if the borrower does not pay the mortgage and we cannot get them to pay, we have what's called asymmetrical returns here. And that is when the downside risk is significantly less than the upside potential. And so when you're a mortgage note investing and the worst thing happens, and that's the borrower stops paying their mortgage, what do we do? In a bad situation, what do we do? Here at Bequest, we buy assets, we buy mortgages that have equity, what we call an investment to value ratio of 65% or less, which means we don't have any more than 65% of our investors' capital in a particular asset. Let me give you an example. Let's say the property was worth about $200,000 and we were buying the mortgage on that property. We would never spend more than 65% of the value on that mortgage. It doesn't matter what the balance of the mortgage is. It doesn't matter what the interest rate is. We would never spend more than $130,000 for that position. So the borrower stopped paying. A situation went really bad. We know if we take back that property through foreclosure, that property will likely sell for 80% of value. So that $200,000 property will sell for $160,000 on average at the foreclosure sale. I mentioned to you, in a bad situation where the borrower stops paying, we have no more than $130,000 into that mortgage. Well, the property just sold for $160,000 in a bad situation, presenting a possible capital gain for the fund. And so those are the types of things that we have in place that make sure that we're protecting our investor capital. And then the last thing, we're very transparent in everything that we do. Our funds are audited. We have gone through extensive processes, even just recently with the SEC. One of our funds is a registered Regulation A fund. We had to go get it approved through the SEC. And so a lot of what we do here is completely transparent, regulated, and we're very open about that here at Bequest.
Sean, I want to ask, I know I'm sure a lot of our viewers are wondering, when you talk about resilience, with, a couple of years ago with the interest rates going sky high, people losing their jobs, the whole COVID thing that happened, like, how do you deal with, the cost of inflation? And I know you touched on it a little bit, but does that have to affect the mortgage notes at all when we're purchasing them?
Yeah, so a couple different things you mentioned, right? If you look at COVID, how did Bequest weather the COVID storm? I don't know if you remember, but this word called forbearance, nobody ever heard of that word before until COVID happened, and that's where people could have called up their mortgage lender and told them that they had a hardship and they couldn't pay. We actually had a lot of that happening during COVID. We managed this portfolio then, but for us, we actually made people prove a need for a forbearance agreement, which is very different than what the federal government did with the debt that they own. They just allowed everybody to forbear their mortgage payments. And so we did a very simple thing, and we just required people to prove a need. During the pandemic, a lot of people still kept their jobs and could pay. And so the fund was fine. We weathered the COVID storm. And then the next thing you mentioned is massive inflation that came out of COVID. How was the fund impacted with the rising interest rates? What's interesting is that the mortgages that are in the fund, most of them are fixed, right? And so 95% of the mortgages that are bought in the fund are fixed, which means that the interest rate's not changing, right? we bought the mortgage. It had a 6% interest rate on it. Yes, rates skyrocketed during COVID. Actually, rates went way down. It didn't impact the performance of those mortgages because the rates were fixed. And we buy a lot of fixed rate mortgages in the portfolio. And so neither one of those impacted. And in fact, right now with the rates that higher, you can see yields are actually going up. It's allowing us to continue buying mortgages. Even this day, we bought mortgages last week. We'll buy more mortgages next week. We can buy mortgages, continue to pay our investors the yield we promised them because interest rates are high. And so we're going to continue doing that. We have a very large portfolio that generates yield. And so that's how we dealt with those two scenarios that you mentioned.
Thank you. Thank you, Sean. I wanted to lead next into some of our, you mentioned that Bequest has been in business for 5 years and haven't missed a payment to the investors. Share a little bit about that.
Yeah, we make monthly distributions to our investors. When you come into the fund, you will come in at a yield somewhere between 8 and 12%, depending on how much you commit and what fund you come into. We make those distributions every month, and we have made those distributions every month. Now 64 consecutive payments. Well over 200 investors call Bequest their investment home, and we're proud of the people that we serve. There is some recommendations here on Bequest from Invest Clearly, which is a great place to go and get references on alternative investments. And we manage well over, now it's almost about 100 million in assets collectively between all the funds that we manage here. And so very proud of what we've accomplished over the last 5 years, and our investors speak for us. We don't speak for ourselves. So thank you for that opportunity.
Yeah, I know we've got Bequest has a Q2 promotion going on right now, and you mentioned earlier that it depends on which fund you're in. So I'm looking at here at your Q2 promotion, and it looks like we've got a legacy fund and an income fund. Explain what these funds are about.
Yeah, yeah. Thank you, Rebecca. We have two funds that we offer here at Bequest. One is a single strat fund, and so there's just a single investment strategy in that. That's all that really means, and that's the income fund on the right. That fund only has, as I mentioned, reperforming mortgages in that fund. That just mortgages in that fund. If you just want to invest in what we say real estate only, real estate investing, like Bequest invest in real estate, you would go in the Bequest income fund. If you're interested in this energy concept, real estate and energy, we have the legacy fund, which is on the left here. That is a multi-strat fund, multiple strategies in that fund. And so that has the performing mortgages, that has some commercial real estate, and then also has some energy infrastructure in that fund. Those are the differences between the two products.
Okay, great. So I'm looking at this legacy fund here. So basically what you're saying is if I invest 500,000 at a 12% return, I can start taking income if I want, correct? Either a check, or if I don't take a check, am I still getting paid? Like, what does that look like?
Yeah, once you invest in the legacy fund, for example, and if you dropped $500,000 into it, and Rebecca, I know that would be a great thing. That would generate $5,000 a month in passive income for you and your family. If you dropped a
That's
half a
awesome.
million dollars into the legacy fund, it would generate $5,000 a month of passive income for you.
Right
And
away.
yeah, and you would be committed to the fund for 2 years. And so at the end of 2 years, you could say, listen, Sean, Martin, I like your fund, but I'm going to leave. And you would leave. We would redeem you out with your 500,000, and you would have earned $100,000 in distributions over the last 2 years. And you would still have your balance with you. And that's the power of cash flow investing. And so that's pretty much how it works. You may say, I want that return. Maybe I'm not ready for that cash flow right now. Maybe I am working right now and I'm trying to build cash flow up for when I do retire. And so you could take that distribution and we call it reinvesting. And so that $5,000 a month that you're getting, you can reinvest that. And so that would go to the balance
Okay.
of your balance with us. So every year your balance with Bequest would go up 5,000 every month, excuse me, would go up $5,000. And at some point you may say, you know what, I want that cash flow. Please turn it on. You just
Mm.
give us a call, you turn it on, and that cash flow being coming into your bank account.
That's fantastic. And I see here that you also have something for non-accreditors as well.
Yes, we do. We have a product that's been approved by the SEC for non-accredited investors, and so there's nobody that we cannot serve here because we have a product for everybody. If you're interested in cash flow and you're interested in investing in cash flow products, we have a solution for you. It doesn't matter whether you're accredited or non-accredited. We do have a product for you.
So this sounds exciting. How can I invest? What does this look like for me? What can I do?
Yeah, there's actually two ways to invest. You can take some excess cash that you have, maybe money sitting in your savings account that you're not using, that you're not saving for a rainy day, and you want to generate some cash flow with that capital. You would just go through a very simple process. You would meet with our team, our sales team here. They would show you what options that we have. Once you pick an option, we would send some documents to you. Our investor relations concierge team would get involved and they would show you some paperwork and send some paperwork to you, and you would just sign it, fill it out, and wire directly or ACH the funds into the fund, and you would become a limited partner. You have an equity stake in the entity that holds these assets, and so that's
Wow,
one way.
that sounds exciting. What you seems like you're going to tell me another way. Is there another way I can invest?
The second way is actually a very powerful way. About 50% of our investors come in through what's called a self-directed IRA account. We've been educating investors for the past 5 years on the power of self-directed IRAs. And you might have an IRA that's been sitting somewhere that is just, you know, you're maybe picking some stocks or some equities. You can actually take that IRA and you can convert it. We have a lot of partners that we work with. You can convert it into what's called a self-directed IRA account. And that the power of converting that, there's no taxable event when you convert that. But the power of that is you can then take those assets and you can invest in alternatives on the alternative market, products that like Bequest has here. You can take that and you can invest. And so once you set up a self-directed IRA account, you can take those funds and you can invest it into any product that Bequest has. And our team, our sales team can kind of help you navigate that process. But what people don't understand is they've got these IRA accounts that are sitting, likely investing in mutual funds that you have no idea where that is going, who's in, what the investment strategy is. You can actually take that, move it, and put it into something that you actually care about, something you understand, an operator that you trust. And so that's the second way to invest with Bequest.
Wow, thank you. Thank you, Sean. I'm super excited. Going back to what I said before, like I really do believe that this is one of the smartest tactics that investors can use in this environment today. And you just brought a lot of clarity and a peace of mind of what cash flow looks like from a Bequest alternative investment mindset. And I just want to bring it back to everybody now that, retirement is a cash flow target. It's not about how much you have saved, it's about how much income and assets you can produce. So I just want to jump straight into Bequest has an excellent team. This is our investor relations team. I'm on the team as well. So if you have any questions and you want to dive in deeper for your personal strategy and what that looks like, you can reach out to Sean or Lena or myself. And we can kind of discuss, like, have a conversation of what's your why, what are you looking to do, and how we can set you up to reach your goals. Um, like I didn't mention this before, but we have a free giveaway. Scan this QR code, or if someone can help me put, let's see if I can do it, bqfunds.com/free. I'm going to type that in here in the chat.
It's
Uh,
there. Yep, I see it, Rebecca.
Oh, someone's got it in there. Awesome. Thank you. You can go there and claim your free gift. And we have lots of free resources. We've got the legacy planner. That's going to help you walk step by step on what your why is and just getting a clear vision so you can take action. We've got the books that our other managing partner, Martin Sines, wrote. My personal favorite is Cash Flow Dojo. Note investing is the one that brings Sean and why he does what he does. And then we've got other podcasts and videos and calculators and just lots of information that you can dive in deep. I always say, make sure you ask questions, do your due diligence. You really want to say, go back to what Warren Buffett's saying is like, you want to understand what you're investing in. So I'm going to open it up to questions. I know we've got some questions in the comments, but Sean, I want to start off with, because I know we touched on it a little bit. I'm going to like ask it again, because I know sometimes people are thinking is, what are the risks with investing in this fund? And what are we doing to mitigate those risks?
Yeah. So as I mentioned, right, it's real estate and it's energy, right? And so if you think about those markets, there's things that can happen inside those markets that can impact any investment, right? If you think about real estate, there are some things that can impact the real estate market. We've seen a lot happen over the last 30 years in the real estate market. We saw a big downturn in the real estate market. It was just about 15 years ago, right? What we've done here at Bequest, the reason we set our investment value ratio at 65% is because we learned what happened through the last housing bubble, the housing crash here in the US. And on average, about 35% of equity was lost. And so that's why we set our threshold at 65% investment to value ratio. By the way, most banks out there will lend at 80% loan to value, right? Every big bank out there will invest at 80% loan to value. We're at 65%. Why? Because we learned that we need to protect our investors a little differently than the banks. We're not getting bailed out like the banks got bailed out in the last housing crisis. And so you think about real estate. What are some of the risks associated? Well, there could be a housing bubble. There could be a housing crash. We've done some things to protect our investors against that. On the energy side, um, you're investing in energy infrastructure. We're building out facilities, infrastructure for the future of AI and blockchain. And so, if there's a big impact in AI and it goes away, or blockchain technology and it goes away, that could impact us. But the reason we're investing in these two types of assets is because we see the future is very bright. We believe there's a massive demand in energy for the US market, and we will lead the world in AI development. On the real estate side, there's still a massive housing shortage. It's out there. And so, because of those things, we believe that the investments we're making are strong, solid investments. There are definitely risks in those different types of asset classes.
Wonderful. Thank you, Sean. We've got some other comments here in the question here. I've got one here. If we don't take the cash flow payments, are we compounding monthly then? So yes, if you don't take the payments, you would be compounding. And I think you have another question to add to that. Is there an opportunity in the principal growth?
Yeah, so we are a fixed income investment. And so when you come into the fund, you are connected to a particular yield for that class. And that's what you're going to generate when you invest in that class. And so the only way to appreciate your principal balance is to reinvest your distribution.
Okay. Okay, great. We've got some time for a couple more questions here. We've got one. Is there any capital appreciation of the investment apart from the monthly distribution?
Yeah, and that was the same question, and I got the same answer.
Yes.
If you
And
want to
then
increase your principal balance, you would reinvest your distribution.
another question, is our mortgage notes, is there any prepayment penalty with the mortgage notes that you hold?
Prepayment penalty. No, we actually prefer when borrowers kind of pay off the loan early. And so here's a good example. We, on average, buy these mortgages at a discount, right? That's how we're able to generate a yield above the coupon. And so if it's a 6% or 7% interest rate mortgage, we're buying that at a discount, right? And so that discount, let's say it's 80, 90 cents in the dollar. When the loan pays off, we're due the full balance, right? We're due every bit of the principal balance, even though we bought it at a discount. That actually creates a capital gain for the fund. And so we're happy when investor or when borrowers, excuse me, pay off these mortgages. We haven't seen that recently because the kind of the resale housing market is a little locked up because the interest rates are higher and people aren't refinancing debt like they used to. But we're happy when investors pay off the loan. That creates a capital gain for the fund. We're happy when investors pay the mortgage every month because that generates cash flow and we already know what the yield is. And so either way, we are happy if people sell the property, pay off the loan, or just do what we expect them to do, and that's pay the mortgage.
Awesome. Awesome. I've got a energy question. We want to know if there's any tax advantages for the investor on the energy side.
On the energy side, I mean, some of the assets that we're investing in do have a higher depreciation. And so we're able to pass on some of that depreciation to our investors. When you come in, you are a equity holder. You're a limited partner in the fund. And so on the K1 that you get, if there's depreciation that we obtain, we push that down to our investors. And so even with some commercial real estate that we have in the legacy fund, we will depreciate everything in that commercial property as fast as we possibly can, and we push those down to our investors. And so, yeah, there's some depreciation that you get to take advantage of that rolls to you on your K1, even though you're getting the monthly distribution. So we do have some scenarios like that.
Awesome. Well, Sean, I really appreciate your time this evening and everyone that you joined us tonight and taking an hour out of your afternoon. And just to leave our audience with this is like, why should one invest in Bequest?
Yeah. Why should you invest in Bequest? Well, if you are focused on building a portfolio that generates cash flow, there is not a lot of opportunities out there. And so we are one of few that will allow you to invest in assets, hard assets like real estate and energy that allow you to generate cash flow that has zero correlation to what's going on in the equity markets. And so I think I presented my case like volatility will continue through the rest of this year. If you want to ride that roller coaster ride, you can do that. But if you want to get off that train and you want to invest in something that's consistent, predictable, that generates cash flow, there aren't many options out there for you. And now is the time to invest with Bequest.
Thank you, Sean. I agree. I prefer safe, steady, and passive. So I am Bequest all the way.
Thank
We
you.
thank you all for joining us, and we look forward to speaking to you one-on-one on a Zoom. So don't forget to scan the QR code or jump on one of our calendars so we can dive in deep on your personal portfolio. Have a great evening. Good night.